There's a pattern hidden in the economy that most people will never see. It's not taught in schools. Financial advisors don't talk about it. The media ignores it completely. But this pattern has predicted every major economic collapse for the last 200 years with terrifying accuracy. It predicted the crash of 1873. It predicted 1929. It predicted 2008. And right now, this same pattern is pointing directly at 2026. Not 2027. Not sometime in the future. 2026. The mathematics are precise. The historical evidence is undeniable. And if you understand what's really happening, you can see the crash coming months before everyone else panics. This isn't about conspiracy theories or fear-mongering. This is about cycles, economic cycles that repeat with the regularity of seasons. Just as winter follows autumn and spring follows winter, economic collapse follows economic boom with mathematical certainty. The cycle we're going to examine today was discovered by a Russian economist named Nikolai Kondratiev in the 1920s. He studied economic data going back to the 1700s and found something remarkable. A long wave pattern that repeats every 40 to 60 years. 4 distinct phases: spring, summer, autumn, winter, growth, prosperity, stagnation, collapse. And we are deep into the winter phase right now, the phase that always without exception ends in financial crisis. Kondratiev didn't just theorize about this. He documented it with decades of price data, interest rates, production statistics, and commodity prices. He showed that these long waves were not random fluctuations, but predictable patterns driven by technological innovation, debt accumulation, and the destruction of old economic structures to make way for new ones. His work was so accurate and so threatening to the Soviet narrative of permanent communist prosperity that Stalin had him arrested in 1930. He died in a labor camp in 1938. But his cycle lived on, and it's been proven right again and again. Let me show you how this works. The Kondratiev wave begins with spring. This is the recovery phase after a major crisis. Infrastructure is rebuilt. New technologies emerge from the ashes of the old economy. Debt levels are low because the previous crisis destroyed most of the bad debt. Interest rates are low. Prices are stable. Optimism is cautious but growing. This is what happened after World War II. The 1950s were a spring phase. America rebuilt. Suburbs expanded. The interstate highway system was constructed. Television became mainstream. The economy was growing. But inflation remained modest. Then comes summer, the boom years. The technologies introduced during spring mature and spread throughout the economy. Employment is high. Wages rise. Inflation starts to pick up as demand outpaces supply. Everyone feels wealthy. The stock market climbs steadily. This was the 1960s, the space race, the golden age of American manufacturing. High employment, rising wages, and growing confidence that prosperity was permanent. But beneath the surface, problems are developing. Debt levels are rising. Inflation is accelerating. The seeds of the next phase are being planted. Autumn arrives next. This is the plateau phase. The peak has been reached, but nobody wants to admit it. Growth slows. Inflation becomes a serious problem. Central banks start raising interest rates to fight inflation, which slows the economy further. Asset prices become detached from underlying values as people chase speculation instead of productive investment. Debt continues to accumulate because everyone believes the boom will return. This was the 1970s and early 1980s. Stagflation, high inflation combined with slow growth oil, shocks rising unemployment. The economy felt like it was stuck. And it was stuck in the autumn phase, heading toward winter. Winter is the crisis phase. The accumulated debt becomes unpayable. Asset bubbles pop. Banks fail. Unemployment spikes. Deflation or a severe recession takes hold. This is the Great Reset, where all the excesses of the previous phases are purged from the system. Businesses that survived on cheap credit go bankrupt. Over-leveraged investors lose everything. Only those who prepared for winter survive to see the next spring. This was the early 1930s, the Great Depression. Thousands of banks failed. Unemployment hit 25%. The stock market fell 89%. It took 25 years for stocks to recover to 1929 levels. That's a Kondratiev winter. The cycle doesn't stop there. After winter comes a new spring, the 1950s and 60s, as we mentioned. Then summer again, in the 70s, autumn in the 80s and 90s. And winter arrived in 2008 with the financial crisis. But here's the critical point. The 2008 crisis should have been worse, much worse. It should have been a full Kondratiev winter that cleansed the system completely. Instead, governments and central banks intervened with unprecedented force. They bailed out the banks. They dropped interest rates to zero. They printed trillions of dollars. They prevented the natural winter from running its course. What they actually did was delay winter, not cancel it, delay it. And that means the winter that was supposed to fully unfold in 2008 through 2010 is still coming. It's been postponed for 15 years through artificial monetary policy and debt expansion. But you cannot postpone winter forever. Eventually, the accumulated imbalances become so large that no amount of intervention can prevent the correction. That point is approaching now. 2026 sits at the intersection of multiple cycles, all pointing towards the same conclusion. The delayed Kondratiev winter is finally arriving. Let's look at the specific evidence. The original Kondratiev wave had an average length of about 50 to 60 years from peak to peak. The last major peak, the point where autumn transitions to winter, occurred in the late 1960s and early 1970s. Add 50 to 60 years to that. What do you get 2020 to 2030? We're in the window right now. But there's more precision available if we look at the sub-cycles within the long wave. The debt supercycle that overlays the Kondratiev wave suggests that maximum debt saturation, the point where the system can no longer absorb additional borrowing, occurs roughly every 70 to 80 years. The last time this happened was 1930 to 1940 during the Depression. Add 70 to 80 years, you get 2010 to 2020. We've already passed into the danger zone, but there's another cycle at play here, the generational cycle. Every 80 to 90 years, roughly the length of a human lifetime, societies forget the lessons of the previous crisis. The people who lived through the Great Depression and understood its causes are gone. The current generation has no lived experience of true economic catastrophe. This creates the psychological conditions for repeating the same mistakes. The last generational crisis peak was 1929 to 1933. Add 80 to 90 years, 2019 to 2023. The timing couldn't be more precise. These cycles don't operate in isolation. They reinforce each other. When multiple cycles align and point toward the same time period, the resulting crisis is exponentially more severe than if only one cycle were turning. Right now, we have the Kondratiev long wave, the debt supercycle, and the generational cycle all converging on the same 5-year window, 2022 to 2027. Within that window, the most likely flashpoint, based on sub-cycle analysis and current economic indicators, is 2026. Not the beginning of 2026, not the end, but somewhere in the middle, late spring, or early summer of 2026, when the system reaches maximum stress. Now let me show you why 2026 specifically. There are leading indicators within these cycles that help pinpoint timing. One of the most reliable is the yield curve inversion. This is when short-term interest rates rise above long-term interest rates, creating an inverted curve on a chart. Every recession since 1950 has been preceded by a yield curve inversion. No exceptions, no false positives. The yield curve inverted in July 2022. It remained inverted for over 2 years, one of the longest inversions in history. It finally uninverted in September 2024. Historically, recessions begin 6 to 18 months after the curve uninverts. September 2024 plus 6 to 18 months equals March 2025 to March 2026. That's your window. Another leading indicator is corporate credit spreads. This measures the difference between what safe borrowers pay for loans versus what risky borrowers pay. When spreads are narrow, it means investors are not worried about risk. When spreads widen dramatically, it signals that investors are fleeing to safety. Spreads always widen sharply right before major economic downturns. Right now, spreads are beginning to widen after years of remaining compressed. The widening started in late 2023 and has been accelerating through 2024. Based on historical precedent, spreads begin widening 12 to 24 months before the crisis hits. Late 2023 plus 12 to 24 months equals late 2025 to late 2026. A third indicator is the velocity of money. This measures how quickly money moves through the economy. When people and businesses are confident they spend money quickly, it changes hands multiple times, creating economic activity. When confidence drops, people hoard cash. Money velocity slows. Before every major recession, money velocity peaks and then starts declining. The current peak occurred in early 2022. It's been declining since then. The historical lag between peak money velocity and recession onset is 24 to 36 months. Early 2022 plus 24 to 36 months equals early 2024 to early 2025. We're already in that window, which means the recession could begin any time from now through early 2025, with the full crisis developing by 2026. Consumer debt levels provide another timing signal. Household debt as a percentage of disposable income rises throughout the boom phase and peaks just before the crash. This happened in 2007, before the 2008 crisis. It happened in 1989 before the early 90s recession. It happened in 2000 before the dot-com crash. Right now, household debt is at near record levels. Credit card debt just hit all-time highs. Auto loan debt is at records. Student loan debt is at records. Mortgage debt relative to home values is approaching danger zones. When debt service payments exceed 15% of disposable income, crisis follows within 18 months. We crossed that threshold in mid-2024. Mid-2024 plus 18 months equals late 2025 to early 2026. Commercial real estate provides perhaps the most specific timing indicator. There's approximately $1.5 trillion in commercial real estate loans that need to be refinanced between 2024 and 2027. The peak refinancing wall hits in 2025 and 2026. These loans were originated when interest rates were 2 to 3%. They're being refinanced at 7 to 9%. The buildings can't support the higher debt service. Defaults will cascade. When commercial real estate defaults reach critical mass, regional banks fail. When regional banks fail, credit markets freeze. When credit markets freeze, the broader economy collapses. The refinancing cliff is steepest in the first and second quarters of 2026. That's your specific timing. But let's zoom out to the bigger pattern. The Kondratiev winter that was delayed in 2008 created what economists call the everything bubble. Normally, bubbles form in one sector. Real estate in 2008, technology stocks in 2000. In the 1920s, it was the stock market. But the intervention after 2008 didn't just inflate one bubble. It inflated everything simultaneously. Stocks hit all-time highs. Bonds hit all-time highs. Real estate hit all-time highs. Cryptocurrencies appeared, and created their own bubble. Even art and collectibles reached absurd valuations. Everything inflated at once because the Federal Reserve was pumping money into the system at unprecedented rates. This creates a unique problem. When everything is in a bubble, there's nowhere to hide when the bubble pops. In 2008, bonds were safe. In 2000, real estate was safe. In 1929, bonds eventually became safe after the initial shock. But in the coming crisis, everything deflates together because everything was inflated together. This is what makes the 2026 crisis potentially worse than any previous Kondratiev winter. The interconnection and correlation across all asset classes is unprecedented. The debt levels underlying this everything bubble are staggering. Global debt reached $315 trillion in 2023. That's 340% of global GDP. In other words, the world owes 3.4 times its annual economic output. For perspective, U.S. debt to GDP was 260% at the peak of the Great Depression in 1933. We're significantly higher now. Big corporate debt in the United States is over $11 trillion. Much of this is zombie debt loans to companies that can only afford to pay interest, not principal. These companies survive only because interest rates were kept artificially low for over a decade. As rates rise and stay elevated, these zombie companies will start failing. When they fail, their lenders take losses. When lenders take losses, credit tightens. When credit tightens, healthy companies can't get financing. The cascade accelerates. Government debt deserves special attention because it's the foundation of the entire system. U.S. federal debt is $36 trillion and rising. Annual interest payments on this debt now exceed $1.2 trillion. That's larger than the defense budget, larger than Medicare. The single biggest line item in the federal budget is interest on past borrowing. This is unsustainable. But as long as interest rates remain low, it's manageable. The problem is that interest rates aren't low anymore. The Federal Reserve raised rates from 0 to over 5% in 18 months. This is the fastest rate increase since the early 1980s. The government's interest burden is exploding. Within 2 years, interest payments will exceed $2 trillion annually. Within 5 years, interest payments could consume 40% of all federal revenue. That's mathematically impossible to sustain. When government debt reaches these levels, there are only 3 options. Default, which destroys the currency and the government's credibility. Inflation, which destroys the currency and everyone's savings. Or austerity, which causes recession and social unrest. All 3 options are bad, but governments always choose inflation because it's the least visible way to reduce the real burden of debt. You don't tell people you're defaulting. You just print money, create inflation, and repay the debt with currency that's worth less. This is what happened in every previous Kondratiev winter. Massive money printing followed by eventual deflation as the system collapses under its own weight. The Federal Reserve is trapped. If they keep rates high to fight inflation, they crash the economy and cause a wave of defaults. If they lower rates and print money, they reignite inflation and destroy the currency. There's no good option. They can choose pain now or catastrophic pain later. Based on historical precedent, central banks always choose to delay pain, which makes the eventual crisis worse. The Fed will likely start cutting rates in late 2024 or early 2025. This will provide temporary relief. Markets will rally. People will think the worst is over. But this will be the final bubble before the burst, the last gasp of artificial prosperity before the delayed Kondratiev winter finally arrives in 2026. Let me walk you through what the unfolding of this crisis will look like based on historical Kondratiev winter patterns. The first phase is the crack. Something breaks. It might be a major bank failure. It might be a sovereign debt crisis in Europe. It might be a Chinese real estate collapse that spreads globally. It might be a series of corporate defaults that spook credit markets. The specific trigger doesn't matter. What matters is that after years of building pressure, a crack appears in the system. This initial crack usually happens 6 to 12 months before the full crisis. Based on our timeline, the crack will likely appear in late 2025 or very early 2026. When the crack appears, authorities will downplay it. They'll call it an isolated problem, a one-time issue, nothing systemic. They'll point to strong economic indicators and low unemployment. They'll say the fundamentals are sound. This is exactly what they said in 2007, when the first subprime lender started failing. It's what they said in 1929, after the market had several sharp drops earlier that year. The denial phase is part of the pattern. Authorities cannot admit the system is breaking because admission would accelerate the panic. So they deny until denial becomes impossible. The second phase is contagion. The initial crack spreads. If a bank failed, depositors at other banks start getting nervous. If a country defaulted, investors start questioning other countries. If a corporate sector is in trouble, lenders start pulling back from all corporate borrowers. Fear becomes self-fulfilling. Credit markets freeze. Nobody wants to lend because nobody knows who's solvent and who's about to fail. This is what happened in September 2008 after Lehman Brothers collapsed. Credit markets completely froze. Companies couldn't borrow to make payroll. The entire system nearly stopped functioning. The contagion phase usually lasts 2 to 6 months. In our timeline, this would be spring and early summer of 2026. The third phase is intervention. Governments and central banks panic. They throw everything at the problem. Interest rates are cut to 0 or below. Trillions are printed. Banks are bailed out. New lending programs are created. Fiscal stimulus floods the economy. Markets stabilize temporarily. People start to think the worst is over. But this is an illusion. The intervention doesn't solve the underlying problem. It just delays the full impact. This phase can last 3 to 12 months, depending on how aggressively authorities intervene. In our timeline, this is summer through fall of 2026. The fourth phase is the secondary collapse. This is when people realize the intervention didn't work. Markets that rallied on the stimulus start falling again. This time they fall faster and farther because confidence has been broken. Unemployment starts rising rapidly. Corporate bankruptcies accelerate. Tax revenues collapse, forcing governments to borrow even more just to maintain basic services. Social unrest grows as people lose jobs, homes, and savings. This phase is the heart of the Kondratiev winter. It typically lasts 18 to 36 months. In our timeline, this is late 2026 through 2028. The fifth and final phase is stabilization and reset. After the system has been thoroughly cleansed, after bad debts have been liquidated, after zombie companies have failed, after asset prices have fallen to levels supported by fundamentals rather than speculation. The foundation for a new cycle is established. Survivors of the winter have capital assets, our cheap new technologies are emerging, the next spring is ready to begin. But this phase only arrives after years of pain. In our timeline, this wouldn't occur until 2029 or 2030 at the earliest. Now, understanding this cycle isn't about predicting every twist and turn. It's about recognizing we're in the late stage of a major cycle and positioning accordingly. The people who understand Kondratiev winters don't try to time the exact top. They prepare early. They build cash reserves during the autumn phase. They avoid debt. They don't chase speculative assets just because everyone else is making money. They accept short-term underperformance in exchange for long-term survival and the opportunity to buy assets at depression prices during the winter. History shows that those who position correctly before a Kondratiev winter can achieve generational wealth. The investors who bought stocks in 1932 and 1933 at the depths of the Depression saw returns that would never be matched in normal times. The investors who bought real estate at foreclosure prices in 2009 and 2010 created fortunes that will last generations. The opportunities that appear during Kondratiev winters don't come around often. Once every 50 to 80 years. If you're prepared, if you have capital, when everyone else is desperate, you can acquire assets at 20 to 30 cents on the dollar. Those assets eventually recover. The 20 cents becomes $1. That's a 500% return. But preparation requires going against every instinct and ignoring all social pressure. During the autumn phase, which is where we are now, everyone seems to be making money. Your neighbors are talking about their investment gains. Financial media celebrates new market highs. Experts say, this time is different. That technology has changed the old rules. Staying liquid and cautious feels like you're missing out. This is the test. The people who can resist the temptation to chase returns during autumn are the ones who survive winter and thrive in the next spring. The specific actions you should consider depend on your situation. If you're heavily invested in stocks, the historical precedent suggests reducing exposure dramatically, not selling everything and going to cash because some companies will survive and thrive, but reducing from 90% stocks to 40 or 50%, using the proceeds to build a cash position that can be deployed when prices collapse. If you own real estate, especially investment real estate purchased with debt, the math needs to be re-evaluated. Can you service the debt if rental income drops 30%? If not, selling before the market turns might preserve equity that would otherwise evaporate. If you're carrying consumer debt credit cards, auto loans, personal loans, paying this down becomes the priority. Debt is an anchor in winter. It forces you to sell assets at the worst possible time just to make payments. Being debt-free provides flexibility. You can wait out the storm. You can buy when others are forced to sell. The wealthy understand this. They use debt strategically during spring and summer to leverage gains, but they shed debt before winter to avoid being trapped. For those with significant capital, this is the time to think about diversification in a different way. Not diversification across stocks and bonds, because both will likely fall in a Kondratiev winter, but diversification into assets that hold value or increase in value during crisis periods. Physical gold and silver, productive farmland energy, generating assets, businesses that provide essential services regardless of economic conditions. These aren't speculative plays. They're insurance against the collapse of paper asset values. The psychological preparation might be more important than the financial preparation. The Kondratiev winter's test resolve. When everyone around you is panicking. When the media is predicting the end of capitalism, when your portfolio has fallen 50% and is still falling, the temptation to give up is overwhelming. This is precisely when you need to be buying, not selling. But having the mental fortitude to act contrary to your emotions requires preparation. Study previous crises. Read first-hand accounts from people who lived through the Great Depression. Understand that what feels like the end of the world is actually the reset that creates opportunity. Internalize this before the crisis hits. because in the moment, rational thought becomes very difficult. There's also the question of timing your preparation. Start too early, and you miss years of gains while waiting for a crash that seems never to arrive. Start too late, and you're selling into a falling market after the damage is done. The answer lies in gradual positioning, not waiting for the crash to be obvious, but recognizing we're in the late autumn phase and starting to shift assets systematically. Selling 10 to 20% of stock holdings each quarter, building cash reserves with each paycheck, paying down debt aggressively. By the time the crack appears, you're already positioned. You're not trying to exit with the crowd. The cycles we've discussed, the Kondratiev Wave, the debt supercycle, the generational cycle. They're not guarantees, they're probabilities based on 200 years of economic history. Could this time be different? Could technology or policy responses break the cycle? Theoretically possible, but unlikely. Because these cycles aren't driven by technology or policy, they're driven by human psychology and mathematical limits on debt accumulation. Technology changes how we produce and consume. Policy changes how governments respond, but neither changes the fundamental pattern of boom leading to bust, leading to recovery. What makes the 2026 convergence particularly compelling is that we can see the stress building in real time. Commercial real estate defaults are rising. Bank reserves are tightening. Consumer savings rates are falling. Credit card delinquencies are increasing. Corporate profit margins are compressing. Each of these would be concerning in isolation. Together, they paint a picture of an economy in the late stage of a cycle, not collapsing yet, but showing all the warning signs that collapse is approaching. The yield curve uninversion in September 2024 was the starting gun. From that moment, the historical clock began ticking 6 to 18 months. That window closes in spring 2026. The commercial real estate refinancing crisis peaks in the first half of 2026. The psychological factors of winter arriving 80 years after 1945, 1946, 97 years after 1929 align in 2026. The delayed Kondratiev winter that was supposed to happen in 2008 to 2010 but was postponed by 15 years of money printing reaches its mathematical limit in 2025 to 2026, when the accumulated debt becomes impossible to service even with artificially low rates. This isn't prophecy, it's pattern recognition. The same patterns that predicted every major crisis for 2 centuries. The same cycles that turned winter into spring, spring into summer, summer, into autumn, autumn, into winter, over and over again throughout economic history. We're not special. This generation isn't different. The cycle continues. And right now, at the end of 2024, we're watching autumn turn into winter in real time. When 2026 arrives, most will call it a surprise. It won't be. It will be the moment a long winter finally stops knocking and walks in without asking, quiet at first, then very loud. The first cracks won't look historic. They'll look administrative, a refinancing that fails, a regional bank pausing withdrawals, a fund gating redemptions temporarily. Explanations will be tidy. The tape will look messy. Spreads inch wider. Liquidity gets shy. Covenants wake up. What worked at 2% debt costs stops working at 7%. Officials respond on cue facilities, guarantees, soothing words. Markets breathe. Commentators declare stabilization. But belief is the true backstop, and belief is thin. Relief becomes a pause. The pause becomes a trap. Phase 2 is speed. Margin calls, forced sellers. Prices fall not because math changed, but because patience did. Good assets are dumped with the bad. The stories turn from idiosyncratic to systemic. What looked like basis points becomes percentage points. For households, the shift is tactile. Groceries are stocked, but the brands you need aren't. Parts take weeks instead of days. Pharmacies substitute. The bill for revolving credit bites harder each month. Work hours are trimmed. Promises feel provisional. Screens glow with guidance. Shelves tell the truth. Preparation matters more than prediction. Hold more liquidity than feels comfortable. Shorten obligations. Write rules in calm and execute them in noise. Prefer resilience to yield. Don't chase havens by label, diversify by function, immediate cash, essentials, productive real assets, and a measured sleeve for the other side. Narratively expect the old choreography, the quiet break, the official reassurance, the relief bounce the deeper leg, the hunt for villains, the slow rebuild. Different faces, same sequence. Somewhere near the bottom, selling exhausts itself. Not because hope returns, but because supply does not. Prices stop falling the way a storm stops raining first, a pause, then a sky you can hear again. Accumulation begins quietly. It will feel wrong. It always does. Winter is not an ending. It is the invoice for years of borrowed warmth. Pay it with patience, cash, and discipline. Preserve optionality. Refuse forced decisions. Wait for prices that reward survival, not swagger. When the headlines call it unforeseeable, remember this was scheduled. Cycles do not ask permission. They reward those who packed for weather and kept walking when visibility dropped. Spring waits on the other side of orderly losses.